Guys, I am so excited to talk about this because we at Money Guide love helping folks build wealth for their financial future. And sometimes that includes showing people that there may be a better path forward. And that's what we want to show you today. This is truly one of the most powerful tools in your wealth building arsenal. And it's called the Health Savings Account, or HSA for short. There's a good chance that you've actually heard of HSAs and maybe you even know a little bit about them. For those that don't, they're basically a type of tax advantage savings account offered to individuals that are enrolled in a high deductible health plan. And the funds in the account can be used to pay for qualified medical expenses. And we'll get into exactly what each of those terms mean later on. But what you need to know is you can use an HSA offered through an employer, or you can open up your own through a large provider like Fidelity Investments. As of 2025, they have contribution limits of $4,300 for individuals or $8,550 for families. And if you're 55 or older, you can contribute an additional $1,000 a year. One thing you can do, regardless of your age, is smash that like button right now. Show it some love. We should note that these differ from flexible spending accounts, or FSAs, in a few ways. FSAs are generally a use it or lose it account, so they have to be used inside of the calendar year. HSAs are not, meaning that they can actually be used as a long-term savings vehicle. They can go year over year over year. And simply opening up an HSA and contributing is an awesome first step. Getting a tax deduction on contributions and having that money set aside is great, but even that is not a step that a lot of folks take. In fact, only 10% of Americans actually use the HSA at all, meaning if you just open one and contribute to it, that can put you in a better spot than 90% of Americans. But what if I told you that you could go one step further? That there's another way to use an HSA, and one that allows you to invest those dollars and actually let them grow. Not only that, but HSAs actually offer one of the most significant tax advantage benefits of any type of account. HSAs offer a triple and potentially quadruple tax advantage when you contribute and invest. The contributions you make to your HSA are tax deductible, that's one. Then when you invest, those dollars grow tax deferred, that's two. And then when you go to pull them out in retirement for qualified medical expenses, those dollars can be taken out tax-free, that's three. In addition, if your employer allows you to put money in directly via salary deferral, those dollars are not subjected to FICA or payroll taxes, which are comprised of Social Security and Medicare. That is literally a quadruple, 4-time tax advantage. But let's break this down to show you just how much further your dollars stretch by using an HSA versus something like a taxable brokerage account. For this example, let's assume $100,000 income in a state with no state income tax, like Tennessee. We're going to use marginal tax rates for this example, since HSA contributions come from the dollars taxed at your marginal rate. If you have $100,000 income, your marginal federal rate is 22%, and the employee's portion of the FICA tax obligation is 7.65%, meaning that those dollars that hit your bank account are already taxed at almost 30% before you ever see them. But HSA contributions bypass all of that. No tax bill on the front end, no tax bill on the back end when used for qualified medical expenses in retirement. It's pretty amazing. And if you do this, there's actually an additional level of optimization. You can pay for your medical expenses out of pocket, which is awesome, like from a checking account or from a credit card, and you can keep the records of what those cost. Then you can continue to let your HSA dollars build up and build up and build up while you invest. And then at any point in the future, you can reimburse yourself with those dollars for past medical expenses. That means you get the best of both worlds. You can invest your HSA dollars and still use them to pay for those medical expenses at some point in the future. And there's no time limit on this, meaning you can let your dollars grow for years and years and years until that expense you had today is just a blip on the radar. And yet, of the 10% that use HSAs, only 13% of that 10% actually take advantage and invest in their HSA. That means that only 1.3% of people are investing in an HSA and taking advantage of this amazing wealth building tool. If you want to be better with money than 99% of Americans, this is how you do it. Now, Some folks aren't going to be able to take advantage of this type of account. And in some cases, it may not make sense to. Remember, you have to be enrolled in a high deductible health plan to be able to contribute to an HSA. Meaning, if you're someone who has a lot of medical expenses every year, or you're expecting a lot of medical expenses in a specific year due to something like a pregnancy, you may not want to do the high deductible plan. You may want to go with the better insurance plan. So how do you actually know that you're covered under a high deductible health plan and that plan is HSA eligible? Well, if you aren't sure of what counts as a high deductible plan, go take a look at your plan summary. And there are two things you want to find. One is your deductible, and the other is your out-of-pocket maximum. Your deductible is the amount that you must pay before the insurance actually kicks in, and your out-of-pocket is the maximum exposure that you'll have. There may also be an HSA eligible checkbox, either checked or unchecked, that'll tell you if you're eligible. So in 2025, per the IRS guidelines, for a plan to be HSA eligible or count as a high deductible health plan, your deductible must meet at least a $1,650 threshold for an individual or $3,300 for families. In addition, the plan's out-of-pocket limit must be no higher than $8,300 for individuals or $16,600 for family. If your plan meets those two criteria, you're likely HSA eligible. Once you've confirmed that you're HSA eligible, it's time to start putting money in. If your employer offers an HSA, you likely don't need to worry about opening your own. Even if your employer plan has high expenses and fees and poor investment options, the FICA or payroll tax break you receive may still be worth it. If there's nothing you can do about a poor employer HSA, you may be able to actually transfer the funds to an outside HSA while you're still working there to get the better investment options and lower your overall fees and expenses. If you don't have an HSA at all through your employer, you'll have to open your own. But the great news is it's super easy to do. Fidelity even offers an HSA with no account fees and a wide range of low-cost investment options. Remember though, whether you use the account for current expenses or reimburse yourself for old ones, they still have to be qualified medical expenses. And there's a lot that goes into what counts as a qualified medical expense. But here's a quick way to check. Go to healthequity.com or hsastore.com. They have a huge database of services and products that are covered as qualified medical expenses. And the really good news is that if you start early enough, these accounts can fully fund any and all healthcare expenses in retirement, meaning all of your other retirement assets can go towards living the life that you want to live. Don't believe me? Well, let's take a look at the actual numbers. In Fidelity's 2024 edition of their retiree benefit study, they found that the average retiree's healthcare expenses for a full retirement was around $165,000. If you adjust that for a 3% inflation rate, that means that a single retiree in 2055 should expect to pay about $400,000 in healthcare expenses. And we know that the current contribution limit for individuals is $4,300. Well, assuming that they don't increase the limits, if you just maxed out an HSA at an 8% return over 30 years, that investment, just at that level, would grow to be about $530,000. You would still have money left over. With that though, a lot of people have questions and concerns surrounding, what if I put too much money in HSAs? If you have too much money in your HSA from investing it and letting it grow, does that mean that all of a sudden the money is just gone and wasted? Absolutely not. First and foremost, having too much tax-free money, pretty good problem to have. More seriously though, there are no penalties on distributions taken from non-qualified expenses in retirement, but they're taxed as ordinary income, similar to how a traditional 401k or a traditional IRA might be. If you think about it, that $530,000 that you built up was triple or maybe even quadruple tax advantaged. So if you had $400,000 of medical expenses and you only have $130,000 left over, it's only that $130,000 that's gonna be taxed as ordinary income. If instead you had built up all $500,000 in a 401k, when you went to pull all of that money out, it's all gonna be subject to ordinary income. So at worst, your excess HSA funds can just be thought of as like a backup retirement account. That's the power of an HSA. It literally allows you to stretch your dollars that much further.